You know what's absolutely insane? There are people making $200,000 a year who feel broke. And then there's Jeff Bezos, who started selling books out of a garage, now worth over $100 billion. So what's the difference? Is it just luck? Intelligence? Being in the right place at the right time? No. It's something way more fundamental. And honestly, it's something nobody talks about because it makes us really uncomfortable. See, the brutal truth is this: earning more money doesn't make you rich. It just makes you a higher paid broke person. And I know that sounds harsh, but stick with me, because what I'm about to show you is the exact psychological trap that keeps 90% of people stuck, no matter how much their salary grows. This is about financial decision making at the deepest level. And by the end of this video, you're going to see money in a completely different way. Let's get into it. So here's where it starts going wrong for most people. You get a raise. Maybe you land that promotion you've been grinding for. Suddenly you're making 30, 40, maybe 50% more than you were last year. And what happens? Your lifestyle inflates to match it. Bigger apartment, nicer car, fancier restaurants. Suddenly, that old coffee habit turns into daily $15 matcha lattes because, well, you can afford it now, right? This is what psychologists call lifestyle creep, and it's one of the most dangerous enemies of wealth-building strategy. Here's the thing, though. It's not really your fault. Your brain is literally wired to do this. There's this concept in behavioral economics called the hedonic treadmill. Basically, humans adapt to new levels of comfort incredibly fast. That rush you got from the new car? Gone in 3 months. The excitement of the bigger house? Fades after the first dinner party. But you know what doesn't fade? The monthly payments. And this is where Jeff Bezos, and pretty much every billionaire, thinks fundamentally different. When Amazon started making serious money, Bezos didn't go buy a yacht. He didn't lease a private jet. You know what he did? He drove a Honda Accord for years because he understood something that most people never learn. It's not about how much you make. It's about how much you keep. And more importantly, how much you deploy. Let me explain what I mean by that. Most people think in terms of income. If I just made more money, all my problems would go away. But wealthy people, they think in terms of assets. And there's a massive psychological difference between these two mindsets. Robert Kiyosaki, the guy who wrote Rich Dad, Poor Dad, breaks it down perfectly. He says an asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. Sounds simple, right? But here's where people get confused. Your house, the one you're paying a mortgage on, that's not an asset. It's a liability. Every month it's taking money out of your pocket. Your car? Liability. Loses value the second you drive it off the lot. That designer watch? Liability. Now, rental property that's generating monthly cash flow? Asset. Index funds paying dividends? Asset. A business that runs without you? Asset. This shift in thinking from income to assets is what separates the wealthy from the broke, and it's rooted in something called delayed gratification, which is basically emotional intelligence in finance. There was this famous study, the Stanford Marshmallow Experiment. Kids were given one marshmallow and told, you can eat it now, or wait 15 minutes and get 2 marshmallows. The kids who waited, they were statistically more successful in life. Better grades, higher income, healthier relationships. Why? Because they understood something fundamental about long-term investing psychology. Short-term sacrifice creates long-term gain. Bezos lived in a tiny apartment while building Amazon. He drove that Honda. He delayed gratification for years, while his friends were buying luxury items because he was playing a different game. He wasn't trying to look rich. He was trying to become rich. Big difference. Now here's where this gets even deeper. And honestly, kinda dark. There's another psychological trap that keeps people broke, and it's called loss aversion. Basically, humans feel the pain of losing money about twice as intensely as the pleasure of gaining it. So what happens? People get so terrified of losing what they have that they never take the risks necessary to actually build wealth. They keep money sitting in a savings account earning 0.5% interest, while inflation is running at 3%. They're literally losing money every year just by trying to protect it. This is where investment psychology comes in. See, wealthy people understand something crucial. The biggest risk isn't losing money. The biggest risk is not putting your money to work. Warren Buffett said it perfectly. Risk comes from not knowing what you're doing. So instead of avoiding risk, they educate themselves. They study portfolio management. They understand asset allocation. They learn the difference between good debt and bad debt. Because here's the truth. Debt isn't evil. Debt is a tool. If you use debt to buy a car that depreciates, that's bad debt. You're paying interest on something that's losing value. But if you use debt leverage to buy rental property that's appreciating and generating cash flow, that's good debt. You're using other people's money to build your wealth. Robert Kiyosaki calls this making your money work for you instead of working for money. And this is the fundamental wealth mindset shift that changes everything. Let me give you a real example of how this plays out. Two people, both making $100,000 a year. Person A gets that paycheck, pays rent, car payment, credit cards, goes out on weekends, maybe saves a little bit. Month ends, money's gone. Repeat. Person B gets that same paycheck, but they've structured their life differently. They're living below their means, not because they're cheap, but because they're strategic. They take 20% off the top before they pay anything else and invest it. Index funds, real estate investment trusts, dividend-paying stocks. 10 years later, person A is still making $100,000, maybe $120,000 with raises, still living paycheck to paycheck, still stressed about money. Person B, their investments have been compounding. That $20,000 a year they invested, it's now worth over $300,000. And it's generating passive income of $15,000 a year. They're not even working for that money anymore. It's just showing up. That's the power of compound interest. Einstein called it the eighth wonder of the world. But here's the thing. It only works if you actually do it. And most people don't. Why? Because of limiting beliefs about money. This is the psychological stuff that nobody wants to talk about, but it's absolutely critical. Most people have subconscious beliefs about money that are completely sabotaging them. Things like, rich people are greedy. Money is the root of all evil. I'm just not good with money. You have to work hard to make money. These beliefs, they're literally programming your financial decision-making without you even realizing it. If deep down you believe that rich people are bad, you're never going to let yourself become rich. Your subconscious won't allow it. If you believe you're not good with money, you'll make decisions that confirm that belief. It becomes a self-fulfilling prophecy. This is where critical thinking comes in. You have to question everything you've been taught about money. Ask yourself, where did this belief come from? Is it actually true? Is it serving me? Because here's what Bezos and other billionaires understand. Money is neutral. It's just a tool. It amplifies who you already are. If you're generous, money makes you more generous. If you're selfish, money makes you more selfish. The question isn't whether money is good or bad. The question is, what are you going to do with it? Now, let's talk about the biggest mistake people make when they do start making more money. They think, okay, I'm making more now. I can finally relax a bit. treat myself. And look, I'm not saying you should never enjoy your money. That's not the point. The point is, wealthy people invest first, spend second. Poor people spend first, save what's left over. It's a simple flip, but it changes everything. Bezos didn't start spending big until Amazon was absolutely dominant, until his wealth was so secure that spending couldn't hurt it. That's the key. Financial freedom first, lifestyle second. But most people do it backwards. They upgrade their lifestyle immediately, lock themselves into higher expenses, and then they're trapped. They can't take risks, can't invest, can't build wealth. They become what's called income rich, asset poor. High salary, zero net worth. And the crazy part? They don't even realize they're broke until something goes wrong. Job loss, medical emergency, market crash. Suddenly, that six-figure salary doesn't seem so secure anymore. So, what's the solution? How do you actually break this cycle? First, and this is crucial, you need to separate your self-worth from your net worth. A lot of people use money as a scorecard for their value as a human being. That's a disaster. Your worth isn't determined by your bank account. It's determined by who you are, how you treat people, what you contribute to the world. Once you internalize that, money becomes a tool, not an identity. Second, automate your wealth-building strategy. Don't rely on willpower. Willpower is exhausting and it fails. Set up automatic transfers the day you get paid. 20% to investments. Before you even see it. Before you can spend it. Pay yourself first. Always. Third, educate yourself on investment risk management. You don't need to become a financial expert, but you do need to understand the basics. How the stock market works. What index funds are. How compound interest builds wealth over time. The S&P 500 has averaged about 10% annual returns over the past 50 years. That means if you invest consistently, your money doubles roughly every 7 years. Think about that. If you invest $20,000 a year, starting at age 30, by age 65, you'll have over $3 million. That's not get rich quick. That's get rich for sure. But only if you start. Only if you're consistent. Only if you resist the urge to spend everything you make. Here's something else Bezos understood early on. The power of ownership. When you work a job, even a high-paying job, you're trading time for money. There's a ceiling to that. You only have so many hours in a day. But when you own equity, whether that's in a business, real estate, or stocks, your money works while you sleep. That's the difference between earned income and passive income. Earned income, you stop working, money stops coming. Passive income, money keeps coming, whether you work or not. And this is where emotional intelligence in finance really matters. You have to be okay with delayed gratification. You have to be okay with being uncomfortable now so you can be comfortable later. Most people aren't willing to do that. They want comfort now. They want the nice things now, and that's fine. But understand what you're trading. You're trading long-term freedom for short-term comfort. Is it worth it? Only you can answer that. Let's bring this full circle. The brutal truth about earning more money is this. It doesn't solve your money problems if you don't change your money mindset. You can make $50,000 or $500,000. If you spend everything you make, you're still broke. Jeff Bezos started with almost nothing. He could have taken the safe route, stayed on Wall Street, made a comfortable living. But he understood something fundamental. Comfortable is the enemy of wealthy. He was willing to be uncomfortable, to drive a cheap car, to live in a small apartment, to invest every dollar back into Amazon. And look where that got him. Now, I'm not saying you need to become a billionaire. That's not the point. The point is, what's your relationship with money? Are you using it as a tool, or is it using you? Are you building assets, or just accumulating liabilities? Are you investing for the future, or spending for today? These questions matter, because the answers determine everything. Here's my challenge for you. Look at your spending from last month. Seriously, pull it up right now if you can. How much of that money went toward things that are appreciating in value? How much went toward things that are depreciating? Be honest with yourself, because awareness is the first step to change. You can't fix a problem you don't acknowledge. And if you realize, like most people do, that 90% of your money is going toward liabilities, that's okay. It's not too late. You can change this starting today. Cut one unnecessary expense. Just one. Take that money and invest it instead. It doesn't have to be huge. Even $100 a month makes a difference over time. The key is starting, building the habit, training your brain to think differently about money. Because here's the final truth. Wealth building strategy isn't about intelligence. It's not about luck. It's not even about how much you make. It's about discipline, consistency, and the willingness to delay gratification. That's it. Bezos didn't have a trust fund. He didn't win the lottery. He made a choice every single day to prioritize assets over comfort, and you can make that same choice starting right now. So drop a comment below. What's the one limiting belief about money you need to let go of? What's been holding you back from actually building wealth? I read every single comment, and I'll respond to as many as I can. And if this video shifted your perspective even a little bit, hit that subscribe button, because I'm breaking down the psychology behind success every single week. This isn't just motivation. This is the actual mental operating system that separates the wealthy from everyone else. Thanks for watching. I'll see you in the next one.